Hi, this is Sameer Sawan, a research analyst, Mirae Asset Sharekhan. The RBI has just announced its April 2026 monetary policy. In this video, I'll cover the RBI's latest decision, the shifts in their growth and inflation outlook amidst global uncertainties, and our expert view on what it means for the markets. What did the RBI do? The MPC unanimously decided to keep the policy repo rate unchanged at 5.25%. The RBI has retained its neutral stance, allowing for flexibility to respond to incoming data. In short, the RBI is adopting a wait and watch approach. While headline inflation is currently contained, the central bank is proactive due to emerging global risks. On inflation is within limits, but upside risks emerge. The RBI is keeping a close eye on prices as new challenges emerge. FY27 CPI inflation is estimated at 4.6%. The quarterly breakdown is as follows: Q1 at 4%, Q2 at 4.4%, up from previous estimates, Q3 at 5.2%, and Q4 at 4.7%. Core inflation is projected to stay steady at 4.4%. Why the caution? Upside risks have increased due to higher energy prices and supply disruptions from West Asia conflict. Additionally, the RBI noted potential El Nino conditions that could impact monsoon and food prices. Domestic growth outlook. The Indian economy remains on a strong footing despite global headwinds. Real GDP growth for FY27 is projected at 6.9%. The quarterly breakdown for the same is as follows: Q1 growth at 6.8%, Q2 at 6.7%, Q3 at 7%, and Q4 at 7.2%. The positives are growth is supported by strong service sector activity, GST rationalization, and robust private consumption. The risks: the RBI highlighted downside risks like the spread of conflicts, damage to energy infrastructure, and rising freight and insurance costs due to West Asia crisis. On liquidity and financial stability. Surplus liquidity. System liquidity has maintained an average daily surplus of 2.3 lakh crore since the last RBI policy. The current account, that is CAD, is expected to remain moderate levels for FY26, but rising energy prices pose a risk to the same for FY27. On currency, the RBI reiterated that rupee exchange rate will remain market determined, and it will only intervene to manage excessive volatility. Key regulatory measures. Several important steps were announced to improve ease of doing business. First, banking capital. RBI removed the restrictive condition regarding NPA provisioning for including quarterly profits in CRAR computations. Second, investment buffers. Commercial banks no longer need to maintain an investment fluctuation reserve, reducing the capital burden. Third, MSME support. Due diligence requirement for onboarding MSME onto TRED's platform have been dispensed with, helping them manage working capital better and reduce compliance burden. Our view on this MPC meeting. Our view is that RBI is maintaining a posture of cautious optimism. While global supply chains face unprecedented challenges, India's domestic fundamentals remain highly resilient. The measures to support capital adequacy are positive for banks. With the current CPI estimates being within RBI's targeted range, we believe the chances of rate hike are low. This stable interest rate environment is particularly positive for rate-sensitive sectors like auto, real estate, and NBFCs. To sum it up, this policy was of vigilance and proactiveness. The RBI is ready to act if global uncertainties spill over. But for now, the focus remains on supporting India's resilient growth story. All our research offerings are now available in one portal, the Mirae Asset Sharekhan Research Center. Explore research calls and detailed research reports across equity, mutual funds, FNO, commodities, ETFs, and more. Visit research.sherkhan.com or scan the QR code to kickstart your wealth creation journey backed by our research experts. Thanks for watching, and we'll keep you updated as the situation evolves.
Investment in securities market is subject to market risk. Read all related documents carefully before investing.